In 1998, Wall Street threw $37 billion at a man in cowboy boots. Bernie Ebbers, a former gym teacher and motel operator, built a telecom empire not through innovation, but pure, unadulterated financial aggression. His company, LDDS Communications, launched in 1983, grew through a relentless strategy of acquisition. They bought regional phone companies, consolidating their networks and leveraging their own stock as currency. The mid-1990s fueled this frenzy. The dot-com era promised infinite growth. Everyone believed data traffic would double every 100 days. This created a land grab for the fiber optic infrastructure that would carry the internet's exploding demand. WorldCom didn't develop this infrastructure, they bought it. They absorbed over 60 companies in little more than a decade, transforming into a titan of the burgeoning digital age. Their crowning achievement arrived in 1998, a jaw-dropping $37 billion takeover of MCI Communications. This deal was the largest corporate merger in history at the time, positioning WorldCom as a literal backbone of the global internet. They owned the pathways, controlled the connections, and were poised to profit from every byte of digital information. Then, 2000 arrived. The dot-com bubble burst. The infinite demand for internet bandwidth vanished overnight. WorldCom was trapped. They had signed massive, long-term contracts to lease telecom capacity from other networks. These were their line costs. But suddenly, no one was buying the bandwidth they had committed to. WorldCom began bleeding cash at an unprecedented rate. The pressure on Bernie Ebbers was immense and deeply personal. He had leveraged his own WorldCom shares as collateral for nearly $400 million in personal bank loans. If the stock fell, Ebbers faced personal ruin, staring down margin calls he could not meet. Enter Scott Sullivan, WorldCom's chief financial officer. To prevent the stock price from crashing, Sullivan concocted one of the most brazen accounting frauds in history. He took ordinary operational line costs, expenses that should have been debited directly to the income statement, instantly destroying profit, and reclassified them. Sullivan moved billions in these daily operating expenses onto the balance sheet as long-term capital assets. This simple, illegal switch made a dying company appear wildly profitable to Wall Street. Billions in permanent losses were magically transformed into corporate investments, painting a picture of strategic spending rather than catastrophic failure. The stage was set for an internal audit showdown. Cynthia Cooper, WorldCom's head of internal audit, became the unexpected protagonist in this financial thriller. She noticed an unusual $400 million corporate credit line entry, a red flag amidst complex financial statements. When Cooper started asking questions, Scott Sullivan, the architect of the fraud, told her to back off. He actively delayed her team's access to crucial financial data, fueling her suspicions. Sensing a cover-up, Cooper and her tiny team began working in secret. They stayed late, long after other employees left, copying files and digging into the financial mainframe before IT could lock them out completely. Their relentless pursuit of the truth finally bore fruit. They found the smoking gun, $3.8 billion in completely fabricated capital expenditures. These were not investments, they were regular, everyday phone line expenses, disguised to inflate the company's value. June 2002. The moment of maximum pressure arrived. Cynthia Cooper took her findings directly to the board's audit committee. Sullivan, confronted with irrefutable evidence, could not justify the numbers. He was fired on the spot. The following day, WorldCom publicly admitted to a $3.8 billion accounting fraud. Forensic investigators later revealed the true scale of the magic trick. It was closer to $11 billion. The stock plummeted to pennies. The market reacted instantly. Over $180 billion in shareholder value was wiped out. overnight. 30,000 employees lost their jobs, their livelihoods dissolved by a spreadsheet lie. WorldCom filed for the largest bankruptcy in US history. Bernie Ebbers, stripped of his cowboy image, was convicted of fraud, conspiracy, and false filings. He received a 25-year federal prison sentence. And Arthur Andersen, WorldCom's auditor, already reeling from the Enron scandal, took its final, fatal blow. The firm, once a pillar of financial assurance, collapsed completely, ending a 90-year legacy. The WorldCom story is not just a tale of numbers, but of leverage, ambition, and the stark reality that in the ruthless game of corporate conquest, even the literal backbone of the internet can be broken by a single stroke of a pen.